Hello everyone, welcome to Blue Dragon Actual. Today is 26th of June. I promise that I'll be sending around 8 videos this weekend, and I think that is a tough task. I promised, and hence I'll deliver. But from next weekend, I have to kind of be careful that I don't overpromise. That is kind of taking a toll on me. But in any case, because of that, I am forced to read through this, and I'm forced to prepare through this, and speaking in a video or trying to explain something requires a lot more understanding than just to do it yourself. So that is helping me a lot, and I hope it is helping you as well. And certainly I see the temperature is rising. I mean, it's right now it's too hot. I don't know why, what has happened over the time that I slept. It's just too hot right now. So take care, stay hydrated, and obviously work out. That will help you. So today the topic is since we have just done the capital management, right? And it was a chapter like I mentioned in that chapter, there was a lot of needless wording that was present in that chapter, and that chapter could have been shortened to 10 pages chapter instead of being a 20-page chapter. That's why the video also got 1 hour long because I had to go through all the points, right? So, however, I think what makes sense next is to go through the IRDA Issuance of Capital Regulation 2015. And unlike that chapter, this chapter is or this regulation is very small or very crisp, and I believe that it will not take that much time. And we'll see this is not talking about the types of capital that you have to kind of go through that entire video of the uh, capital management, because it is related to capital management, right? It is not about the issuance of capital, but in this case you will be only concerned about the issuance of capital, especially the how a company comes for IPO or something like IPO. Recently LIC came for IPO, and it got listed at at a small premium. Then it is kind of, because the entire share market is falling, so LIC is also falling. But in any case, I believe LIC have strong fundamentals. Whenever the Indian stock market crashes, it's the LIC who kind of bail out the stock market. So yeah, so I believe this would be a small video. Now it is for regulations. It is very important that you mention that it is a regulation, so that there are types of regulations or guidelines. This is a regulation. Then there will be guidance note. There will be actual practice standards. So it is very important that you like, especially in the SAT exam, that you refer to that as regulation only. Like, you cannot say guidance issued by IRDA for issuance of capital. It's not a guidance, it's a regulation. Similarly, there will be circular, right? There is a like we'll go through the derivative circular. So it is a circular, it is not a regulation. It's very important to mention that, and if possible, try to mention the correct year. So this is the 2015 regulation. Now the way we are going to cover any regulation is, I'll first go through the sections, like I'll give my understanding and summary of it, and then we'll go to the regulation to see if I remember or memorize things correctly. So that will help me to kind of do a like check if I remember things, and also any mistake that I would be making would be kind of caught. So I'll be helping myself, and hopefully that would also, like, the double study that we'll be doing. Like, once I'll speak from based on my memory, and then I'll go through the points that is written. So that will probably help to ingrain these concepts in like in everyone's head. And this is regulation, so this is written in a slightly legal or a slightly complex language. So we have to kind of uh, like go into deeper to understand what is the underlying meaning behind it. Sometimes the language can be a bit tricky to understand. Written like, provided this happened, provided that happened. So you have to kind of see the holistic picture, right? So coming back to the issuance of regulations, any life insurance companies who is kind of transacting life insurance business in India cannot go for issue of shares or issue IPO or subsequent issue of shares to SEBI without prior approval by the authority. Here, authority means IRDA, and prior approval by the authority, without any prior approval by the authority, basically. And those under this regulation. So in SEBI, the regulation for which you kind of list the share, that regulation is called ICDR regulation, right? So no insurance company transacting life insurance business in India can approach SEBI for under ICDR regulation to issue shares or subsequent issue of shares without written approval by the authority. for issue of shares under this regulation. Now, any life insurer that is kind of transacting life insurance business in India can issue shares by the following method. One is the divestment of equity of the promoters or other investors. Second is issue of shares. Third is both one and two, provided that shares cannot be transferred beyond that is specified in the Insurance Act, which is beyond that is specified in the Insurance Act, which is 6A, 4B, 2, and 3. And that portion, like transfer of shares, is covered by the IRDA transfer of shares mechanism, IRDA transfer of share regulation. Right, so that is not part of this regulation. In this regulation, the only thing that probably someone is concerned is about divestment of equity and shares. So the company can approach SEBI for issue of shares under ICDR regulations anytime after they are granted the certificate of registration, provided that if there is any lock-in period that the promoters or the investors had that the authority or the IRD has prescribed, that they has to abide by. And the insurer is required to submit their application as part of the Appendix A that is given in this regulation. And when the insurer can issue shares in as paid up shares or partly paid up shares. But if it is partly paid up means that the payment has not happened. Like for one, say if one share is costing 50 rupees and the shareholder, the investors paid only 25 rupees, but they have got the share, so 50 rupees is still pending, 25 rupees is still pending. So if that is the case, then the insurer is required to kind of get the payment in next 1 year, like if the shares are partly paid up. Now, what are the conditions that the insurer will kind of examine? The insurer will first see the financial position of the insurer, its compliance with the regulatory record, the financial position or the solvency position after the issuance of capital, and what is the purpose for which the capital has been raised. Okay. Now, without prejudice to the generality of the point one above, what this means is if the point one fails, like the point that I just mentioned, what is the purpose, the financial strength, compliance with the regulatory condition, etc. If this point fails, then there is no point moving ahead. If all this point is kind of valid for the insurer asking to raise capital, then the regulator or the authority, in this case IRDA, will look for further things. What are those further things? First of all, IRDA will see the time that the insurer has, duration the insurer has been in business, is compliance with corporate governance guidelines, is compliance with policy protection. So all these are very important because we understand that the regulator is concerned about the policy, like if the insurer is able to meet its liability, right? So that's why these are very very important. Then the solvency position of the insurer, which is the solvency position of the insurer in the preceding 6 quarters, starting immediately from the quarter in which the date of application has been filed. And then there is a regulation on I can remember. So there is a yeah there was a there is a regulation on that the embedded value report has to be filed by because when you are going for issuance of capital, and embedded value report is must, and it has to be filed when independent actually, where the authority or the IRD can allow the issue applicant to kind of file that embedded value report 30 days prior to the filing the prospectus. Prospectus is the file that any applicant kind of file for the ICDR regulation with the SEBI, right? That is also known as DRHP, draft rendering prospectus. That is the draft of every detail that the authority has, and also the financial purpose for which the regulation. So we have also already covered the purpose, and yeah, I think these are the points. So I'll stop here and see if we have covered all the points, and then we'll move forward. The next point will be when the what are the restrictions or the what are the challenges that the authority might face in approving the application. Indian insurance company transacting life insurance business shall approach SEBI for the public issuer shares, which is the IPO, or any subsequent issue whatsoever called under the ICDR regulation. So without specific approval of the authority in writing under this regulation. I have mentioned this perfectly. The regulation shall be applicable for the applicant company to raise fund through any of the following steps: divestment of equity, issuance of capital, both 1 and 2, provided any issue of capital other than as specified in 1, 2, and 3 above, including any transfer of share beyond the specified limit, will be as laid down under 6A, 4B, 2, and 3 of the Act, shall require prior approval of the authority. Such transfer of share has been governed by the IRDA transfer of equity shares of insurance company regulation 2015. So I have mentioned this part as well while I was speaking. An applicant company proposing to raise share capital in a public issue in the terms of this regulation may do so at any time after the grant of certificate of registration, provided the promoters investors shall abide by the lock-in period. Should be filed as per Form A, and I mentioned Appendix A, which is kind of incorrect. So as per the Form A, right? These are the things that you have to remember in regulation. You cannot just say Appendix A. If that Appendix A doesn't exist, your marks will be deducted. You Form A, right? And the applicant company may issue fully paid up shares or partly paid up shares. So if it is partly paid up shares, then applicant company shall not allow any period exceeding 1 year for the payment of the call on shares. This point I have also covered. Consideration for the application: the authority shall consider the applicant company's overall financial positions, regulatory record, an application for issue of financial position. Right, we have covered this. It's regulatory record. I mentioned compliance with the regulatory, so that has been covered. The application for issue for offer of sale, the capital structure post issue offer for sale, and the purpose for which the capital has been. So I think without I have already covered this. Then without prejudice to the generality of one above, like if this point is not holding, then this point will not come into question at all. This is the most important point. Then the history of compliance with regulatory compliance, how long the company has been in business, the maintenance of prescribed regulated solvency margin. So the point that I forward is compliance with the disclosure requirements. Right? This is the point that I forward. The compliance with the corporate governance guidelines. Another point that I forward was compliance with the Indian owned and controlled. This is a very important point that I forward. India compliance with the Indian owned and controlled and read along with Indian insurance companies, Indian companies foreign investment regulation, Indian insurance companies foreign investment regulation 2015, and any guidelines issued by the authority in this regard. So this is a very important point, because this is the basis on which the authority may reject the application, right? The record of policyholder protection and the embedded value of the company, the embedded value shall be prepared by an independent actuary, right? And in the manner prescribed by the actual practice standard issued by Institute of Actuaries of India. So this is something that we are going to cover. This is the APS 10 in the next week, provided the authority may allow the applicant company to file report for the independent actuary at least 30 days before the issue of prospectus or draft credit prospectus. So there is an entire process. See how cumbersome the process is and what details the authority go through to understand that this company is good to go for IPO, so that public money is kind of not wasted. They look after the solvency position, they look after the corporate governance, they look after policy protection, and even if it is, if it is in detrimental to the interest of the insurance industry, that's why the company has to be insurance like Indian owned and controlled, right? And which has to be read along with the Indian insurance company there. And the disclosure is very important, because you are raising money from the public, so disclosure should be very important, and this would be without any prejudice to the ICDR regulation, which we'll see in the next part. So the next part would be related to the approval of the authority. Right, the authority, while according approval, the authority may specify particular limit, specify maximum limit to which the promoters or the other investors can divest their equity. There may be a maximum subscription limit for the foreign investors. So foreign investors cannot put money beyond the. This is related to that Indian owned and controlled point. So the applicant company has to abide by the disclosure requirements for under this regulation, which will be without any prejudice to the disclosures required for the ICDR regulation. The ICDR regulation also requires some some disclosures. So both would be like both one cannot say, okay, this ICDR requires this and this regulation required this, so these are counterfeiting contradictions. So what should I do? So both the disclosures has to be provided. Whatever is required by ICDR and whatever is required by this particular regulation that we are going through, both are required. Now there is a, you remember that there is a point, what I initially mentioned, that when you are divesting a share, or kind of issuing shares, there is a type of transfer of shares, right, which is as per the 6A, 4B, 2 and 3. So these are governed by different regulations. So that is the next point, that the article of association of the company needs to be amended, so as to so the article of association of company needs to be amended so that there is no change in the so there is no transfer of shares beyond the prescribed limit as given in 6A of that, and any other things that is deemed fit by the authority. The authority may still reject the application if it is not in compliance with the regulations, if it is a bad regulatory record, basically, if it is not in the interest of the policyholders, if it is not in the interest of the insurance industry, right, and if it is not meeting the solvency capital requirement, right. So after this, the authority would try to kind of give approval expeditiously, but the insurance company would also have to be kind of expeditious in replying to any queries raised by the authority. And the after the authority gives the approval, that approval is valid for a period of 1 year, and within that 1 year the insurance company has to file the draft red herring prospectus, get all other approval if that is something is required from, say, a legal approval or something. All the approvals would be required within that 1 hour 1 year period, and the authority may still extend the the approval by 6 months. But if 1 month 1 year 6 months have passed, then again the same cumbersome process has to be followed. Again, the approval has to be taken by the insurer if the insurer failed to kind of list the company by that time period, which is initially it is 1 year, and it can be extended by 6 more months. And then finally, the authority can direct an insurer to get listed on the company, and the insurers without any even if the insurance has any lock-in period restriction, that would not be applicable then, like the promoters and shareholders. The insurers will, within 1 year of such direction, the insurance has to get listed in the stock market, right? So this is the entire regulations that we have seen, and now we'll go through the remaining part of the regulations. So approval of the authority, the extent to which the promoters and investors have dilute the respective shareholding. This is the limit prescribed. There is a maximum subscription limit for the foreign class of for investors. Minimum lock-in period. This is one of the point that I've missed. Minimum lock-in period for the promoters and investors from the date of allotment. So that's why we've seen that many times the share fall when the minimum lock-in period is kind of passed. Like for example, in Zomato, there was a lock-in period of I think 1 year or 6 months. I don't remember. Immediately after the lock-in period ended, the promoters or the venture capitalists, they sell their share, and the stock market, the share fell. So that's why there is a minimum lock-in period for the promoters and investors from the date of allotment of shares. Disclosures or the prospectus, which are in addition to the disclosures which are prescribed by SEBI or ICDR regulations, right? Modifications in the article of association of the applicant so as to explicitly provide that no transfer beyond the limit specified in 6A of that shall be recognized without prior approval of authority, because this falls under a different regulation, right? So this is the only point that I have missed, that minimum lock-in period for the promoters, and any such other conditions as may deemed fair by the authority. Like any approval of the authority under this regulation shall not be in any manner deemed to serve as a validation of the representation of the application company. So the insurance company cannot say, okay, IRDA has kind of approved my application, so you know that my business is very strong. That cannot be like that. That cannot be shown as a means of promotion, and it has to be disclosed in bold letters in the offer document. So this is also another point that I have kind of missed. Right. So these are the points that I have to be careful about. That when I'm kind of memorizing, I'm not able to recollect this point. The authority will not accord this approval if the insurance company is not compliant to regulatory framework. Once again, another point that I've missed is consequent upon the dilution of the shareholding by the promoters and investors. So this is related to the India owned and controlled. That is the same point that I missed there. right? So I miss that Indian owned and controlled point, and because of that, I also miss this point that it is not Indian owned and controlled. Then, if it is not in the interest of the policyholders, I mentioned this, and if it is not in the interest of the insurance industry, finally timelines as expeditious as possible. The authority shall process and grant and shall ensure prompt response to the queries. The applicant company has to ensure prompt response to the queries. This is valid for a period of 1 year, right? But within which the applicant company has to file the draft trading prospectus, and maybe on the receipt of the written request, extend the validity for the period of further 6 months. The authority may direct any Indian company transacting life insurance to get listed on the stock exchange if the circumstances so warrant. Such company notwithstanding any lock input. That's what I mentioned, right? So within a period of 1 year from the date of such direction, should comply with the direction issued by the authority. So, and this is formal. This is how we need to file. You can see the embedded value report, right? And this has to be signed by the chief executive officer, the chairman of the board, solvency position of the last 6 quarters. So everything that we have read is kind of like in this tabular format. One has to kind of get those details and fill those details, right? These are the format. This is the format that you are required. So I'll put the link in the description. So if one needs to go through this, they can go through this and see all the risks are covered. So this is kind of ORSA, like this is kind of taken from the ORSA of the Solvency II. So all the risks are here. But the most important thing here is what are the consideration, like for this regulation, what are the consideration based on which the authority is kind of giving permission to the insurer, right? That is in which that single point that I forgot, that the 2 points I forgot. One is the disclosure requirements, required with the disclosure requirements, compliance with the disclosure requirements, and the second point was related to the Indian owned and controlled, right? And read along with the Indian Insurance Companies Investment Regulation 2015 Act. And when what are the limits or the restrictions? So minimum lock and period, that was the point that I forgot. And once again, in the authority may still not grant approval even after everything is perfect if it is not Indian owned and controlled, if it is not in the interest of the policyholders, if it is not in the interest of the insurance industry, and if it is not regulatory compliant. So if it is not regulatory compliant, then it is not meeting the few criteria that we have mentioned about, right? So that's it, and I hope you get a flavor of regulation from this. And this is how the regulation has to be kind of memorized, and you have to kind of replicate. You're not required to write whatever is written in the regulation perfectly, but your answer should show that you remember most of the point in the way that, especially those provided point. You need to know when there is an exception, right? So that's it. Stop the video here, and see you in the next video. The next video probably on the guidance note 22, which is regarding the stochastic modeling, because we have heard so much about the stochastic. In the investment was regarding stochastic, then the asset liability management was stochastic. So we're going to, we're going to read about that next. That will be slightly bigger. Probably take around 30 minutes to get covered. So yeah, thanks.